Well, let's focus on earnings then. We're focusing on Anand Rathi Wealth. The company reported revenues a little below than expectations. However, margins improved sequentially. The management has also raised their PAT as well as their margin guidance for the remainder of this fiscal. Feroz Aziz, who is the Deputy CEO of the company, joins us on the show. Hi, Feroz. Good morning and good to see you in. Feroz, let's focus first on the guidance that you've upped. If I go by that, it's implying there'll be a marginal growth in revenue, but your profitability will decline by close to 10-12%. Fair to assume that for the fourth quarter?
See, I think from a margin standpoint, we look at our business more simplistically than microscopically because we are in the business of wealth management. So we look at our PAT margin to be above 30% at all points in time. That's the number which we are very possessive about, PBT greater than 40%. Anytime we see that, we don't want to pocket the operational efficiency just yet. Because this business has a lot to reinvest in. For example, I have 161 research people only focusing on India. The day I see my PBT margin at 44%, then it's time for me to spend 2% on the global side, hire 50 people outside, and propel growth for longer periods of time, because we've given a long-term guidance of 20-25% for long periods of time, for 10, 15, 20 years. So that will require some degree of reinvestment. So coming back to your point, whether we've revised our guidance, what we feel proud about, or not proud is a stronger word, we feel happy about, is the fact that we always undercommit and over-deliver. And this last quarter was a very bad quarter or the second worst quarter from the time we got listed. From a market standpoint, Nifty was down 8.97%. In that quarter, if we have grown 33%, gives us some santvana and some calmness that we got the highest new monies in a quarter, which was not the best from an external standpoint.
All right, take that point, and not only would we give you some credit, but we'd give credit to a lot of the mature investors as well, Feroz, who've decided to deploy their wealth at the time of the markets not particularly doing well. So we've come a long way on that. But while you've got money, I'm compelled to ask you this. I'm looking at your presentation, and FY22, your equity MF net inflow share was 1.9%. Net inflows for SIP purchases was 7.2%. Look at it now. For the first 9 months, your market share in equity MF has stayed largely stable at around 1.8%, and net inflows for SIP purchase is down to 4.8%. What explains this, and what's your market share target here?
Yes, Mangalam, the credit of net flow goes to you. Most of my clients, HNIs, watched TV18, and I'm very happy to say that, because most of the cream a la cream of India sticks to your channel, and there's nothing wrong to admit that. So a large portion of the credit of my net flows goes to the education which TV18 does, and hand on heart, that's a compliment, heartfelt. Coming to the more pointed bit of where we see market share. See, if you have to look at market share of 4.8% on net flows in a country where there are lakhs and lakhs of distributors, I have 383 relationship manager colleagues. And if I have been able to get 4.8% of the net flow without giving discounts to people, we don't believe in lower cost, lower value model. We believe in taking that 1.09% post GST, which I earn on my 14 scheme model portfolio. I don't let that go. Even if somebody promised me 20,000 crores of assets to manage at a discount fee, I say, no, that's not going to be happening. So in spite of not discounting, if I'm able to get to 4.8% of market share, I would be okay, happy. Of course, there's headroom. You can look at it 7 down to 4.8, but you can look at 4.8 in a country with 373 lakhs crores of people and lakhs of ARNs. If one ARN with 383 representatives have got you 5%, 4.8 rounded as 5. I would be okay and happy, because I think last quarter was not the best in terms of net flows for the financial year.
All right, Feroz, the growth in active client families and the AUM per RM as well has dipped. The growth in active client families has slowed a little bit. And if I look at the AUM per RM, that's dipped on a sequential basis. Yet your margins improved. How is that? Tell us, what are the factors that played out?
Nigel, you are very sometimes kind, sometimes unkind. When the market does very well, you attribute all the AUM growth to market. When the market falls, you tell me.
No, Feroz, that's not true, Feroz. Just asking you what your shareholders want to know, and I'll have to also rope in the fact that valuation-wise, Anand Rathi gets a pretty good multiple. So you could answer both the points on the margin, as well as, as someone who's been with the group for so long and led the way from the pre-listing days as well. What do you make of this premium multiple?
Yes, Nigel, on a lighter note, I was saying that now let me not dodge your first question. In terms of what has happened is, see, there's a 9% fall in the Nifty. There is broader markets have fallen a little more last quarter. So we've just grown 1.5-2% quarter on quarter, 39% from December to December, 55,000 to 76,500. We have given a guidance of 80,000 because if 10% falls on 50% of my assets, which is equity mutual funds, then straight I lose 4,000 crores of mark to market at least, or if all the money was as much as Nifty beta only. So that's why if you see this on a quarter on quarter basis, it will give you a deceptive picture, and I'm sure the shareholder should look at how the business is from the way this business is being run. So I would look at it year on year. So 55,000 crores has become 76,000 crores, which is a 39% growth from December to December. Now coming to the valuation, see what happens is market always discounts the future. Valuations, yes, I would say if you measure PE as a barometer, we are at least 10, 15, 20 PE greater than the second highest PE, including asset management companies in this industry. I personally think after spending 13 years in this company, the 5 reasons why our businesses, if I was looking at it from a shareholder standpoint and trying to decipher why do we get 15 PE more, the 5 reasons which I look at, we're the best ROE. There was one report which just got released the last week where ROEs are best in the country, and that's also looks at 12 businesses, right, global and Indian. We had an ROE of 45%, which was the highest. PEG, which is the great barometer. I've heard Motilal Oswalji always say PEG is a better measure, and I have been his bhakt. So PEG in India, in all financial services businesses which were there in that chart, which was about 6-7 Indian businesses, we were the best, 0.8, 0.9 as per that report I'm just quoting.
Right.
Then Ventura was the report which I'm quoting. Third, attrition. We are a people's business. Attrition being 0 is first time in the Indian financial services industry. Somebody can say in the regret attrition for 15 months prior to this quarter, right, we had 0 attrition. So that's one reason. No new products launched. Till the product machinery is in autopilot. Generally, when you launch new products, like even a phone manufacturer launches a new product, there's an increase in revenue. With right, no new product launched for the last 12 years, our business is consistently growing at 33%. That's the mean and median for the 13 quarters I've been listed. The standard deviation of my result, my worst quarter for 13 years has been 24.5%, has been the worst quarter.
You know, Feroz,
in spite of markets giving a lot of shocks. So these are few of the reasons. And in bad markets, if you can produce a financial services business which can do well, there is some premium I think market would be giving. But these are some of the reasons I could probably put on table as my assessment.
All right, Feroz, you believe that we should look at the numbers with a longer term horizon instead of looking at it on a sequential basis. You've laid out some guidance, but that's indicating some bit of softness in the fourth quarter, though you're very confident of achieving that. And as you're saying, you're confident of, you believe that you'll deserve a higher PE as well. And, that was a question with regard to the higher valuations, but you believe it's justified. Thanks a lot for joining in. We'll try to quiz you a little bit further. Maybe the next month or so, we re-invite you on the show and quiz you about how business is going on in the fourth quarter.